Welcome to the 5-Minute Prime Podcast. Quick, actionable tips to master personal finance and real estate investing. In just 5 minutes a day, we'll help you build wealth and achieve financial freedom. Hey Prime investors, Martin Maxwell here, and welcome back to the 5-Minute Prime Podcast. This is episode 43. Remember when we talked about the sheer cost of mortgage interest? How a $300,000 loan can balloon to nearly $600,000 over 30 years. That hidden price tag is a massive wealth drain. We also discussed in episode 42 how many baby boomers own their homes outright, highlighting the financial freedom that comes with being mortgage-free. So today we're flipping the script. Instead of just accepting decades of debt, we're diving into accelerated mortgage payoff strategies. How can you attack that principal balance, save tens or even hundreds of thousands in interest, and build equity faster? It's about taking control and making your mortgage work for you, not against you. Let's get into it. Let's quickly revisit why paying off your mortgage early is such a powerful move. Using our example of a $300,000 loan, at 5.3% over 30 years, the total interest paid is over $300,000. You essentially buy your house twice. Paying it off faster brings some significant advantages. First off, you achieve massive interest savings. Less time paying means significantly less interest paid to the bank. That's money back in your pocket. Next, you'll find you're building equity much faster. Equity is the portion of the home you truly own. Paying down principal faster accelerates your ownership stake, giving you more financial flexibility sooner. This ties into the wealth-building principles we often discuss, like in episode 4 about the compound effect. Plus, once that mortgage disappears, you gain increased cash flow and freedom. That hefty monthly payment vanishes, freeing up significant cash for other investments, goals, or simply enjoying life. This is a core component of achieving your financial independence FI number, which we covered back in episode 2. And finally, you achieve reduced risk. Eliminating mortgage debt provides immense financial security, especially during economic downturns or unexpected life events. Being mortgage-free is like having the ultimate financial cushion. Okay, the benefits are clear, but how do you actually do it? Let's explore the most effective strategies, starting with the simplest. This is often the most accessible strategy, paying more than your required monthly payment. Even small amounts make a huge difference thanks to how mortgage amortization works, where early payments are mostly interest. Any extra money you pay goes directly towards the principal balance. This reduces the base on which future interest is calculated and shortens the loan term. Now let's take that $300K 30-year 5.3% loan again. That's about $1,668 per month. If you add just $100 extra each month, you end up saving nearly $42,000 in interest and shave about 4.25 years off the loan. Double that to $200 extra and the savings become even more substantial. So how can you make these extra payments happen? One popular way is using bi-weekly payments. You pay half your monthly payment every 2 weeks. Over a year, this adds up to 26 half payments, which equals 13 full monthly payments instead of 12. It's an almost painless way to make one extra payment annually. Just be sure to check with your lender first to ensure they apply the extra payment correctly to the principal. Another approach is making manual extra principal payments. Decide on a fixed amount, maybe $50, $100, $500, whatever fits your budget, and add it to your payment each month. Make sure to clearly designate it as extra principal. Finding this extra cash might be easier than you think. Those budgeting hacks from episode 6 could help. And don't forget about using occasional lump sums. Things like work bonuses, tax refunds, or small windfalls are perfect opportunities to make extra principal payments whenever possible. Now, a really important note here. Always ensure extra payments are applied directly to principal, not just credited towards future payments. You need to communicate this clearly with your lender. And remember the advice from episode 7. Make sure your emergency fund is solid before you start aggressively paying down relatively low-interest mortgage debt. Extra payments are great, but what about changing the loan structure itself? Let's look at shorter terms and refinancing. First, consider a 15-year mortgage. Opting for a 15-year term instead of 30 years from the start or refinancing into one later dramatically cuts the interest you'll pay. On that same $300K loan at 5.3%, a 15-year term means a higher monthly payment, around $2,417 versus $1,668. but the total interest paid plummets to about $135,000. That saves you roughly $165,000 compared to the 30-year option. Plus, you build equity much faster and are debt-free in half the time. The main consideration? Ensure the higher payment fits comfortably within your budget, accounting for the full PTE: principal, interest, taxes, insurance. Keep in mind the rising costs of taxes and insurance, which can impact affordability. Alternatively, if market rates have dropped significantly below your current rate, refinancing is another avenue. You could refinance your existing mortgage either to a lower rate on a 30-year term, which frees up cash flow you could choose to put towards principal, or directly into a 15-year term. Either way, refinancing can save you money and potentially shorten your payoff time. But watch out for the closing costs associated with refinancing. They can be several $1,000s. Make sure the interest savings clearly outweigh these costs. Use a break-even calculator to be sure. Also, be aware that refinancing restarts the amortization clock, so double-check that the new structure truly aligns with your goal of accelerating the payoff. Beyond those core strategies, a few more points come to mind. For instance, if you receive a significant lump sum, like an inheritance or proceeds from selling another asset, evaluate using it to pay down or even pay off the mortgage. This provides a guaranteed saving on future interest payments. Also, consider the opportunity cost. Aggressively paying down a relatively low-interest mortgage isn't always the absolute best financial move for everyone. Ask yourself, could you potentially earn a higher return by investing that extra money elsewhere? Perhaps in assets that build passive income, like those discussed in episode 25 or aligning with the rich mindset from episode 27. It really comes down to a personal decision based on your risk tolerance and broader financial goals. And regarding taxes, while mortgage interest is tax deductible, remember that recent tax law changes mean fewer people itemize deductions now. So the value of this deduction might be less significant than it once was for many homeowners. Don't let a potentially minor tax break deter you from saving significant amounts in interest. As always, it's wise to consult a tax professional, a point we emphasized back in episode 36. Finally, think about the impact of house hacking. If you're employing strategies, the rental income generated can be directly channeled into making extra principal payments, which can seriously supercharge your mortgage payoff timeline. Your challenge for today: find an online mortgage payoff calculator. Plug in your current loan details, balance, interest rate, remaining term. Then experiment. See how much interest and time you'd save by adding just $50, $100, or $200 extra to your principal each month. The results might shock you and provide the motivation you need to start today. And as always, if you found this episode insightful, please subscribe to the 5-Minute Prime podcast, share it with a homeowner looking to save money, and leave us a review. You can find more resources, tools, and links to previous episodes like episode 2 on calculating your FI number and episode 22 on workforce housing at reiprime.com.